Today we will be discussing the key differences between financial and managerial accounting. These differences are critical as managerial accounting takes the ideas learned in Accounting 220 and expands upon them with new tools and concepts which allow students to better understand the ways managers can use accounting to successfully run a business. The main difference between financial and managerial accounting are the users. For financial accounting, the users are primarily external, such as investors, creditors, and the government, like the Securities and Exchange Commission, the Federal Trade Commission, and the Internal Revenue Service. The primary users of managerial accounting are mostly managers and employees within the company. Another difference is the purpose of these both types of accounting. For financial accounting, the main purpose is to help investors and creditors make investment and credit decisions. For example, creditors can use the financial statements or 10K to see where a company stands to determine if it's a good investment or not. Another example is that creditors can utilize reports built by financial accountants to determine the eligibility of a firm for a loan and for the firm's capability to pay it back. The primary purpose of managerial accounting is to help managers and employees within the company make internal decisions. For example, managers can use this type of accounting to calculate direct and indirect cost of different cost objects. They can also use information to calculate the unit cost per item. This information could help managers cut costs and evaluate the performance of the company and determine what measures could be implemented to improve. Managerial accounting reports also usually contain information that is company-specific and is not meant to be public. The focus and time dimension are another way that financial and managerial accounting differ. Financial accounting is more focused on the past. For example, in financial accounting, the financial statements and reports report on the performance of the previous year. The income statement for 2017 would not be prepared until 2018, whereas in managerial accounting, items like the budget are prepared, which is more focused on the future. It is focused on strategies to help improve productivity or profits. Another difference is the different rules and restrictions that both types of accounting are required to follow. Financial accounting is required to follow GAAP, or the generally accepted accounting principles. GAAP is meant to ensure a minimum level of consistency among public companies and their various reports. Public companies are also required to be audited by independent companies. The purpose of the audit is to ensure the standards of GAAP are being met within each firm. GAAP protects investors and creditors from fraudulent financial statements. Managerial accounting is not bound by GAAP because their information is mostly used for internal purposes and is only used by managers within the company. It is based on a cost-benefit analysis, which just means that managers weigh cost against benefits to help make decisions. Managerial accounting is not required to be audited. Although managerial accounting is not bound by GAAP, it is held to the standards of the Institute of Managerial Accountant, or IMA Statement of Ethical Professional Practice. Some key standards from the statement are competence, confidentiality, integrity, and credibility. The key principles are honesty, fairness, objectivity, and responsibility. The IMA is a reminder that just like financial accountants, managerial accountants are expected to exhibit the highest level of professional and ethical behavior. The standards require management accountants to maintain their professional competence, preserve the confidentiality of the information they handle, and act with integrity and credibility. Managers also have a responsibility to the company's stakeholders, which include customers, creditors, suppliers, and vendors. Once again, however, as managerial accounting is used for internal purposes only, the government is not nearly as concerned with what is produced so long as the statements from the company's financial accountants remain truthful. Financial and managerial accounting also compile reports on a different time basis. For example, financial accounting generally prepares reports on a quarterly or annual basis, which is required by the SEC, whereas managerial accounting prepares reports depending on what kind of information the manager needs and when they need it. They could do it as often as by the minute or on a daily or weekly basis. The last difference between financial and managerial accounting is that financial accounting is mainly concerned about the accurateness and quality of the reports, whereas managerial accounting is mainly concerned about how reports will affect employee behavior. Financial accounting is also concerned about how it affects employee behavior because, for example, many managers' compensation is based on their performance, which can be seen on the financial reports. However, it is only a secondary concern. In summary, financial accounting's primary role is to provide accurate information creditors, and investors, while managerial accounting focuses on the inner workings of a company and is used by those in management positions to make decisions about the company's future goals.